Okay, Peter, you ready?
Yes,
Ernie?
I'm all ready.
Ernie, you ready? Hey, Brandon, you ready?
I'm good to go.
Okay, here comes the boring slow guy, and let's make this a really good webinar, not like the last ones. Hello, everybody. I'm leaving now. Okay, welcome to Wednesday, August 24th, 2022, and the first webinar ever given by Peter Farrell and Tierney Gilmore. We're going to talk today about the Inflation Reduction Act, what it does and what it doesn't do. And the good news for most of us tax advisors and for most taxpayers is it doesn't really do much at all. It will fund the IRS, and that will make some changes, hopefully more changes for the better than for the worse. And it will affect some very large companies and those of us who want to buy electrical vehicles. It may also impact divorce rates, as I believe Peter or Tierney will discuss. So we're going to just go through our slide deck. If you have questions, you will see the question pyramid. Let me show it to you. By the way, we do not give continuing education credit for this course because it's not good enough. And if you have questions, you can just click the inverted pyramid, type in the question, and if we know the answer, then we'll let you know the answer. If we don't know the answer, we'll pretend we did not see it. So we do know the legislative history of this bill. It came mostly from what was to be the Build Back Better bill. That never made it quite through. So what we have obviously is a compromise. What a couple of the resistant senators insisted on seeing in this bill got into the bill, and what they insisted on not having in the bill got out of the bill. And I'm sure there were a lot of political contributions made at the last minute to make things happen, which is how the sausage is made in Washington. So Peter, do you want to give us a little bit of an overview here and start on slide 5?
Sure, Alan. So we're going to break this into 4 main categories of changes that the act makes. The first involves healthcare costs for Medicare beneficiaries, as well as extending some of the subsidies for the Affordable Care Act that were set to expire at the end of the year. The act has quite a bit in regard to climate change initiatives. It is definitely the largest climate change act that has ever been passed in the United States. There are some changes to how corporations are taxed, including a new corporate stock buyback excise tax that Brandon will talk about. And then there's also increased funding for the IRS for tax enforcement, compliance, and different modernization initiatives, including money to start essentially an IRS-funded TurboTax type system to file your taxes. Some Senate Democrats released this chart showing that they expect that the act will raise $737 billion in revenue. There's expenditures of $437 billion, and they expect there to be over $300 billion in deficit reduction as a result of this. And of course, that coming from the Senate Democrats. What is supposed to be the nonpartisan CBO estimates that the act will reduce the deficit by approximately $100 billion over the next decade, and also estimates separately that the additional IRS tax enforcement part of the act will increase tax revenues by an additional about $200 billion over the next decade, and we'll talk about that in a little bit. This is kind of a graphical representation of the spending for the bill. So the size of the rectangle indicates its relative amount. It's in billions of dollars over the next 10 years. You can see the biggest thing are the extension of these Affordable Care Act subsidies, the new tax credit for emissions-free electricity sources and storage, different credits for wind and solar power, and you can see also the $34 billion for the Medicare prescription drug changes. The revenue, you can see the biggest thing is this 15% corporate minimum tax that Brandon will talk about, $124 billion for IRS enforcement, and the other revenue sources are listed there as well. All right, I think Brandon can talk to us a bit about this new 15% minimum corporate tax.
Yeah, so this is the big revenue raiser of the bill. And the good news for most of us probably on this webinar is that this only applies if you have income in excess of $1 billion. So if you don't represent any corporations with revenues of that amount, you can just disregard this minimum tax. You might want to know about it just so you can advise on it if people have questions or those type of clients come in, but generally it won't impact your practice much. But for those of us that do represent those corporations or have some involvement and need to understand the tax, I'll go through a little bit of the details. I will say I'm not going to get into a lot of detail about it because it is pretty dense and complex. But for the most part, what it does is it imposes this 15% tax on your bottom line financial statement income. So that is the generally accepted accounting principles, financial statements, that bottom line net income amount is what this tax is going to be imposed against. The other important part of this is that in years where your actual typical tax, the 21% flat tax that corporations now pay, exceeds the 15% corporate minimum tax, you get a carryover to offset future years to the extent of that difference. So let's say, for example, your bottom line net income is $1 million, and that matches up exactly with your financial statement income and your tax income. So there's going to be a $60,000 difference there because of the difference in the rates. That $60,000 will carry forward to the next year. And if the corporate minimum tax is $60,000, you now have that credit from the prior year to back off against that tax. So I think that's going to be an important part of this, is tracking those carryovers to the extent that they apply. This comes into effect starting next year, so all your 2023 taxes are going to have to worry about this corporate minimum tax. So as I mentioned, this tax only applies if you have over $1 billion, and that's defined as average annual adjusted financial statement income. And what they do is they take an average of a 3-year period. If that 3-year average is over $1 billion, then you now are an applicable corporation that this tax applies to. The bad part about this is once you meet that threshold, you're going to be subject to this corporate minimum tax, even if the next year your income drops back below that $1 billion. They haven't really told us yet how you get out of this. It does apply on a change of ownership. So when you have a change of ownership, I guess you restart the testing. And then here you'll see in the second bullet point, part B, that if you have a specified number that's to be determined through regulation of consecutive taxable years that are below the threshold, then you get out of being an applicable corporation and no longer have to worry about the corporate minimum tax. So it's not just a year-by-year test. Once you hit the test, you're going to have to worry about this for at least 2, 3, 4, who knows how long, until you have multiple consecutive years of falling below the threshold. So what adjustments apply on that bottom line net income amount when you're computing this tax? I'm going to hit some of the highlights here. These are not all of the adjustments that will occur, but I thought these were some of the main ones that would, most clients or most corporations would be dealing with. So you take the bottom line net income that's on the financial statement, you adjust for differences in tax versus book depreciation. So your bottom line net income is going to be book depreciation amounts, but you actually have to apply the tax depreciation amounts to calculate this tax. You get a reduction for your state and local income tax expenses. That's not already in your bottom line net income, so you reduce to the extent those apply. An interesting part here is that in that bottom line net income, your defined benefit plans and the growth of the pension plan is going to be included in that amount potentially. You get to back that out for calculating this corporate minimum tax, but only for purposes of applying the tax. When you're applying the test to see if your income exceeds that $1 billion, you have to include those defined benefit plan incomes in that calculation. So there's a difference there between what you apply the tax on and what you are testing against to see if you meet the threshold. Some other items of note: if you have differences in tax years, those are going to have to be adjusted. Income from any partnerships or disregarded entities owned by the corporation, that's going to be brought in. There's a lot of rules related to foreign source income and how that's treated for purposes of these rules. I didn't get into that. Those of you that deal with foreign corporations probably understand why, as it's very complicated and hard to explain in a brief short webinar as this one. So just remember that there are adjustments for those types of income items. The other thing to make mention of is net operating losses and how this impacts the corporate minimum tax. If you do have carry forward losses, you can offset up to 80% of your bottom line net income with those net operating losses for purposes of applying this corporate minimum tax, but only those losses generated after 2019. So if you have losses before then, they're not going to come into play with respect to this tax. So just to summarize here again, how does this apply? You take your typical income tax as you would normally apply that for the corporation. That's the 21% flat tax. You get that number. And then you apply this 15% rate to your book income, that bottom line net income amount, and you have to pay the greater of the two. So those corporations that engage in tricky tax reporting and are able to minimize taxable income while showing large earnings on the books, this tax is really going to impact them and raise a lot of revenue for the IRS. So Alan, Peter, any questions there before we move on to the buyback stock?
The real question is, how soon is this going to be, if the Democrats take control after the next election, is this going to be on all C corporations?
Yeah, I mean, we'll have to wait and see. That is one concern. I know some articles, one of the articles in Lineberg that we have attached to the slide mentioned that as a possibility. If they drop this to, say, $10 million of income, then now we have a lot of corporations that could potentially be dealing with this. It would be a huge revenue booster. I don't know that it would really impact a lot, though, because a lot of those smaller corporations don't really have a lot of difference between tax and book income as well, too. So that's another consideration, and I think they're really trying to target the the Apples and the Amazons of the world to hit with this tax. So we'll just have to wait and see on that. But I wouldn't expect that to be a hot topic or an agenda item, but who knows? All right, so the stock buyback tax, what is this all about? So this is a new tax that will apply if you don't pay dividends and you instead buy back stock from stockholders. You're now going to be hit with a 1% excise tax to the extent of those repurchases. So if you buy back $5 million worth of stock, 1% of that will be taxed and considered as an excise tax that's going to be payable to the service. There's a few exceptions to this. One, if you buy back stock as part of any type of tax-free reorganization or merger acquisition type of techniques, then that's not going to be included in this 1% excise tax. You also have to buy back stock in excess of $1 million. So if you're below that threshold, this tax doesn't apply. It's only to the extent that it exceeds the $1 million. There's going to be some regulations issued on this as well that might contain some more exceptions, but I wanted to mention those at the outset here. A little bit more detail on the tax, what exactly a stock buyback is for those that need refresher on that. And again, it's simply just a 1% tax on stock repurchases to try to discourage those stock buybacks and encourage dividend distributions that are actually taxed instead of being more tax deferred like stock buybacks are. So Peter, I'll kick it back to you if you want to talk a little bit about what the IRS is going to be doing with all of this money that was allocated to them under this new act.
Thanks, Brandon. All right, so one of the more controversial aspects of this bill, if you've been watching the news, I have a bad habit of watching CNBC, and but the act gives about $80 billion over the next 10 years to be allocated proportionally each year. It's broken up here. You see $3 billion for various taxpayer services. The controversial part, that $45 billion for increased enforcement, $25 billion for operation support, and then almost $5 billion for business systems modernization. And these funds are in addition to the $13 billion that the IRS receives annually, at least for fiscal 2022. But one interesting thing to note about this money is that because it's distributed over 10 years, a future Congress, if let's say Republicans were in control, could adjust the allocations away from enforcement or could decrease the funding altogether. So the 10-year period leaves a bit of uncertainty about how this will all play out. The CBO determined that the returns should be good. By investing the $80 billion, the IRS will collect $203 billion, so $125 billion net gain in tax revenue. The Treasury Department has done research, which we'll look at in a second, that says that typically for every dollar spent on enforcement, the IRS gets $4 back in tax revenues. That's a little bit different than the CBO estimate, but that's what they've seen in the past. And as I said, there have been a lot of concerns about this, concerns that IRS agents with guns are going to come to people's houses and demand that they pay their taxes. And in response to some of these concerns, Treasury Secretary Janet Yellen released a letter on August 10th. And while this isn't binding, she says that the audit rates will not rise relative to recent years for households making under $400,000 annually. Now, some people have pointed out that you could file a return for, say your income is $300,000, but if the IRS thinks that you actually have an additional $150,000 of unreported income, you could still be within that $400,000. But she says specifically, I direct that any additional resources, including any new personnel or auditors that are hired, will not be used to increase the share of small business or households below that $400,000 threshold below historic levels, and that they want to focus on high-end non-compliance and what they call crucial challenges like large corporations, high net worth individuals, and complex pass-throughs, where today the IRS has resources to initiate just 7,500 audits annually out of over 4 million returns received from those sources. And then she notes at the bottom there, for every additional hour auditing someone making more than $5 million annually, it generates an estimated $4,500 of additional taxes collected. Now, we're going to take her word for it that they're not going to do that, but that at least is what they've said publicly is their intent. Now, the Treasury Department released this document called the American Families Plan Tax Compliance Agenda in May of last year. This is, of course, the Inflation Reduction Act is a different bill, a different act, but this was a bigger, the American Families Plan was a much larger bill that was part of Build Back Better. And one of the things that has persevered into the Inflation Reduction Act is the $80 billion that they discussed in this Treasury document. So I thought it might be good to go through and say how they plan to spend the money when they released this in May of last year. So they say the big problem is to close this tax gap, the tax gap being the difference between what is actually owed by Americans in taxes and what is actually collected. They say the tax gap totaled nearly $600 billion in 2019, and they estimated that it will rise to about $7 trillion over the course of the next decade if it's not addressed. They point out that 99% of taxes due on wages that are reported on W-9s are reported, which is you probably expect, since that is they can check that. But that the tax gap disproportionately benefits high earners who have income from from other areas. And so they expect to use this $80 billion over the next decade in a few different ways, and we will look at those here. One of the biggest here is on, as they point out, for technology. The IRS uses its systems are based on a programming language, I think it's called COBOL, which was developed in the 1950s. And I think the last time there was major updates to it was in the 1960s. Some banks and other financial institutions still use this programming language, but it is certainly not a modern programming language. So part of this money would be to put money toward that. Also, they point out that there are over 1.4 billion cyber attacks are experienced by the IRS annually, which is a little concerning. And so this money will go to improve systems to protect taxpayers. Oh, going the wrong way here. Still going the wrong way. Let me. So one of the things that since the early 2000s, the IRS budget as a share of GDP has been trending downward. The IRS overall budget declined 18.5% between fiscal 2010 and fiscal 2021, and then its enforcement budget actually decreased by 15% over this period, and leading to a 20% decline in the IRS workforce, and that the share of audited returns declined by approximately 49% between 2010 and 2018.
I mean, if you look at this, so individuals who made between $1 million and $5 million in 2010, the audit rate was 6.67%. Now it's 2.21% in 2018. People from 5 to 10 million, from 11.55% audit rate to 4.21, and 10 million above, 18% audit rate to 6% audit rate. So you can see why the high earners are a little bit concerned. There's going to be more audits. There's no doubt about that. So what does that mean for us as tax professionals? Well, for most of us, it doesn't mean much, but it would be better to be more conservative, knowing that 3 years from today, there's a bigger chance of an audit than there might otherwise be. And on the estate and gift tax side, if you're going to make a move and report it on a gift tax return, make that move this year as opposed to next year, because there's a better chance that they won't be ramped up 3 years from this year than 3 years from next year. So we're going to hopefully have a more organized, more effective, better educated IRS. A lot of times right now we struggle with IRS people who may not have as much education as they would otherwise like to have, may not have the systems that they would like to have, and if they're tripping over themselves, they may trip over us as well. So this may be a blessing in disguise to have a well-funded, well-educated IRS who knows what they're doing and causes less distortion in the situation. So Peter, we've got about 7 minutes left in the presentation. Is there anything that you wanted to point out besides what we've just covered?
We can skip ahead maybe to this Medicare part, and we'll go over that quickly.
Okay, go ahead.
So a couple of things here. Cost sharing price of insulin for Medicare Part D beneficiaries is now capped at $35. There's going to be a cap starting in 2025 for those beneficiaries out-of-pocket cost at $2,000. There's some discussion about this decrease in drug prices, the method of which that currently the U.S. government is explicitly prohibited from engaging in price negotiation with drug makers for Medicare recipients. Starting in 2026, they're going to have to pick 10 drugs that are covered by Medicare Part D that do not have generic equivalents and negotiate for those, and then that number increases over time. Vaccines should be, many vaccines for adults should be free for Medicare beneficiaries. And the last big thing is that some subsidies that had been introduced under the Affordable Care Act were set to expire at the end of this year, and those have been extended, I believe, for another 3 years. And you notice that's actually the biggest spending part of the act. And then I think Tierney is going to talk just a bit about some of the climate provisions.
I think you're muted. Still
Okay.
muted there? There we go.
Yeah, sorry, it's not connected. Okay, sorry. So as we stated earlier, the act does also have climate provisions. A lot of it has to do with incentives and credits for different technologies, fuel methods, nuclear reactors, hydrogen fuels, carbon recaptures and storage, heat pumps, especially green home renovations, coastal renovations, and new and used electric vehicle sales. So for I don't have power anymore. Can someone go to the next slide for me? Sorry, thank you. So for green home renovations, there was previously a lifetime cap of only $500. That has been extended to $1,200 annually for remodels, which means that homeowners can take big energy efficient upgrades and budget them over 10 years. Unfortunately, there are no incentives for homegrown medical marijuana, so you're going to have to keep relying on family members for that one. Next slide, please. For the coastal restoration, apologies, there are good news for both the fish and the wealthy. They are planning to set aside $2.6 billion in grants to both conserve and restore coastal habitats, which is great news for our reef and also great news for the wealthy and the resort owners who keep their properties up against the coast. For the next slide, please. For electric vehicles, it's something that a lot of people are very excited about, but unfortunately, it's not as exciting as everyone thinks that it is. The Act intends to bring electric vehicle production mostly into the United States, if not completely into the United States, by 2028. In order to get the benefits of this act, it has very strict requirements, which is unfortunate because many manufacturers aren't able to meet these requirements, which means their electric vehicles don't qualify for the credits. Even some brands, one vehicle of a certain type may, because it was created within the United States, while another was built outside the United States, and although they're the same vehicle, one may qualify and the other may not. Currently, it's about 15% of the minerals that are currently used for these electric batteries are produced in the United States. And like I said earlier, we'd like to get that to 100%, or this act does. For the next slide, please. Thank you. There's no active assistance for new purchasers. It more comes in the form of a credit. The annual income, you have to make less than $150,000. It is $300,000 if you are married, which is what we joked earlier. It kind of promotes divorce almost, because, you know, if you're married to a very wealthy person and you get divorced, suddenly you get a credit for your electric vehicle. Yes, thank you. This is a little bit of an easier to view breakdown. So if it's a new car, you have to make less than $150,000. If you're a joint filer, it's $300,000. If it's a used electric vehicle, it has to be, you have to make less than $75,000 or $150,000 jointly. If it's a new car, it must be completely assembled in North America. It must come from a qualified manufacturer. Most qualify at this time, but it is up to the EPA's discretion to change that definition as it currently sits. The MSRP of the vehicle has to be less than $80,000 for SUV, vans, and trucks, or $55,000 for any other vehicles. For the used car, it has to be at least 2 years old, and it has to be purchased from a dealer, which means no buying from your friend and trying to get a credit that way. And the total price of the vehicle has to be $25,000 or less. That's the value of the vehicle, not the price that you paid. Your benefits, if it's a new car and you meet all of the criteria I just stated, you get up to a $7,500 tax credit. $3,500 of this is if 40% of your battery has the critical minerals that I mentioned earlier, and they're from the United States. The other 30%, oh, that got deleted. The other 30% is if all of the battery components were manufactured within the United States. If it's a used car, the tax credit you get a tax credit of 30% of the value of the vehicle up to $4,000. And as I stated earlier, this is all tax credits, it's not purchase, there's no rebate, and all of this is for personal use cars. There also is, next slide please, there's also a commercial vehicle electric credit, which actually covers both batteries and fuel cells, which were debated heavily by both sides. If the vehicle weighs more than 14,000 pounds, they're eligible for only up to that $7,500 credit. If the vehicle weighs over 14,000 pounds, they're eligible for the credit of up to $40,000. That $40,000 or the $7,500 is per vehicle, and then you can also get up to 30% of cost of the electric chargers, up to $100,000. In order to calculate this, you have to do the difference between the purchase price of a comparable gas or diesel powered truck and the purchase price of your electric vehicle, or 30% of the price of the electric vehicle, whichever is less is the credit that you would get.
And Tierney, sorry to just interrupt real quick. I just saw an interesting question from Linda here, and she asked if the credit was refundable or not, meaning if you have if the credit reduces your tax liability below zero, do you actually get money back from the IRS as a refundable credit? Or if you just get to reduce to zero and you don't get that refund? And unfortunately, it is a non-refundable credit, meaning you can just reduce your liability to zero. You can't actually go below zero and get money back from the IRS with this credit. So I just wanted to address that. That was a good question.
Thank you.
Well, it looks to me like this over the years will have a profound impact on how car manufacturers gear their vehicles to these prices. And I think we're going to see a lot more electric vehicles, especially if the gas prices stay high. Okay, so those of you interested in the AMT, there's a very good Lineberg newsletter that just came out on the 23rd. Which happens to be today. And I thought that Michael and Jim did a great job on this, so I've reproduced it with their permission. So, Brandon, do you see any other questions that we should address? I thought that Peter and Tierney did a great job on this so that we didn't have to.
Yeah, no, they did a really excellent job. I see one question about if you can stack the credit with the Section 179 deduction, and I'm not sure the answer to that, but we're looking into it and see if we can get to the bottom of it. But Tierney, I think you did mention that this has to be personal use, so I don't know if you can 179 as a personal use vehicle, so that might be one issue there. Let me see if I see any other questions here. A lot of people are asking about copies of the slides. Those are going to be emailed out, following the webinar, as well as a recording of the webinar.
Yeah, that'll be in about 2 hours. You'll receive a video copy of the webinar, and it'll also be where you can click through to YouTube, and then you can forward it to your friends and your enemies. Between the time that you're spending applying for a job with the IRS. And I'll say a lot of young tax professionals started with the IRS and finished with the IRS, or then come out to the professional world much better for having worked for the IRS. So I think that's going to be a definite change, and it's going to be even harder for us tax law firms and CPA firms to find tax professionals, because the IRS will be hiring, and isn't such a bad place to work from what I understand. So we want to thank you again for attending this webinar. If you have any questions whatsoever, you can email Brandon at gassmanpa.com. I'm at gassman@gassmanpa.com. Please check out our YouTube video site and our Saturday at 11 a.m. YouTube videos. Brandon and I will be speaking, mostly Brandon will be speaking, this coming Saturday, 11 o'clock, on income tax planning as part of the estate planning process. Tierney, congratulations on your first webinar ever. You did a great job. Peter, good job. I hope everybody has a fantastic rest of your afternoon and that you buy an electric vehicle. Thank you.